What's good, YouTube? We are back with another video, and in this segment, I'm just gonna simply teach you guys the second step to day trading, which is a fair value gap. So you'll go here, new shapes, start a rectangle, and boom, draw it out. Go to your settings, style, put the middle line black, whatever you like it. Color would be the border. You can change it to anything you want, and then you could change this something, bright, dark, anything. And there you go. So what is a fair value gap, and how do you trade it? So a fair value gap, it consists of a 3 candle pattern where it starts with one candle, whether it's going to the upside or the downside. And I'm going to show you this bullish example real quick. And it's where the second candle is the volume candle where it expands. It could have a small wick, a long wick, does not matter. It could look like that, it could look like this. And all it means is that now the third candle is the importance. Does this third candle trade back down to this first wick? Like, meaning this wick is longer, because now there will be no gap. You cannot draw a gap through this wick. But if this wick is shorter than the first one, meaning it could be here, it could even be like right there, right? There just has to be some space even there. Gonna make this example look a little bit more neat. And boom, you draw the first wick to the third wick right there, and there you go. You draw it through the body of the second candle, and there you go. You will have your bullish fair value gap. And it's the same exact way for a bearish example. We'll erase this, take this line, put it here, take this line, put it there, boom. And here's the example of a bearish fair value gap. So now remember, it's the second candle, it's its expansion, right? And that is how you'll get your fair value gap. But remember, this wick cannot trade up to that first wick. So it cannot look like this, it cannot look like that, because now it's above that. So it has to be below. And when you see it in the market, you'll be able to start spotting them out. Very, very simple. So here you go. You have a bearish fair value gap where now this candle potentially opens, somewhere down here and trades back up into it, just like that. And it, taps in the market, and boom. So let's erase all these drawings real quick, and let's find a pretty quick example. So we'll jump to the 4-hour, and if you look, you can spot one out right there. Bearish. As you can see, first candle, that wick, expansion candle. And look how this wick does not trade all the way up here. It opens right there, and the wick trades that high, candle closes, and boom, now you have your fair value gap. And what does the market start doing? It tries to hunt this gap. So it's trying, right? But we're gonna put this in theory that this candle came up in here, and boom, tapped inside of this gap. And now, what does it mean, right? So what is a fair value gap being valid or invalid, right? So for a bearish example, this means that this wick trades up into this gap. And if we're bearish, we'll look for something like this. Boom. And then, boom, we trade out of it. Targeting, our sell side liquidity levels here and here. And, you could take your short position because you're bearish inside of a bearish gap, with your stop loss above it, targeting sell side. So it's very simple concept to trade it. A fair value gap is not something you just look at and you draw it out and you automatically have your trade. No. So here's a bearish example. Oh no, a bullish example, I'm sorry, of it actually holding and us starting to get, legs out of it. Boom. First wick, expansionary candle, third wick. When we draw it up, that's what it would look like if I did not draw it out. But you always draw it out because, again, if we're bullish, we have a high right to the left of us, right? And then boom, we have lows down here. See how this low actually got swept right there? Got swept. So now that low it's invalid. It's already taken. It does not matter. Boom. So we have a low right there. So in this case scenario, right, we're inside of this bullish 15-minute gap. If we're bullish, this gap holds, and then we're long, looking to take out buy side. And your long position could look something like this. Stop loss below the gap, and you're just simply targeting buy side. If you had $500 right here on this trade, you would have made 1,000 while risking 500. Boom, we start to, take this high first, you can go break even, and now you're risk free, waiting for, your buy side liquidity to get taken out. So that's a valid gap holding. So now what's a invalid gap, right? What's an invalid gap? Well, an invalid fair value gap is when the market had already closed through the top of the fair value gap to either or side. So here's a bearish example. First wick, expansion, and look at that third wick. It does not trade back up, meaning we have a gap. But if I draw it out, do we close through that gap? Well, we had a gap, right? We sell back off, boom, we're trading back up, and boom, we're in the side of this gap now. What happens? We close through the top. Simple as that. Now it's invalid. Excuse me, meaning this gap, it's invalid. It doesn't matter anymore. It's old news. So let's find a bullish, right? A bullish fair value gap getting ran. We'll jump down to the 3-minute time frame. Mind you, all this price action is fractal. So it means that you can go on each time frame and it keeps telling you, your understanding. So a bullish gap, first wick, expansion candle, third wick. Does it trade back down to that first wick? No. And I draw it out, right? What happens though? If we're bullish, right, we would look to see these relative highs get taken out the market. But what happened? We trade through it, and now this is simply invalid, right? Looking to take out these lows. If you zoom all the way in, we did not take that low. So we have equal lows down here, right? So we have equal lows to the downside, right? And we are inside of this 3-minute bearish gap. But what happens? This candle closes through. So that means, am I bearish or am I bullish in this position? For me, I would be bullish. Why? Because we trade through a 3-minute after failing to take out, that low to the left of us. And since this gap is getting invalidated, 3-minute gap gets invalidated, I can trade the inverse, meaning since we inverse this 3-minute, meaning we close through and now it's invalid, I can take a long position confident, right? If it's my system and my model, and I can take it to these equal highs. Simple 1-to-1. Say you had 300 on this trade, boom. You made 300. So it's not about trading this every second of the day, every minute of the day, and trying to find a fair value gap. No. You're simply looking for a fair value gap that holds or gets invalidated to your draw on liquidity in favor of what you're seeking, or if you weren't seeking that, then you have to react. You have to be able to just be loose in your bias and be able to look for something that is going to be that. So another example, we got buy side, we got our sell side. I'm looking, right? And boom, I see we got these highs right here, right? Starting from this high. Because other than that, we only have these highs up there resting. So boom. We got buy side right there, right? So in theory, right? Here's how you can trade a fair value gap. Boom. You take out this buy side level, right? We take out this level. And now, after buy side's taken, what are we looking for? We're looking for a way to start targeting lower. If the market isn't going to show you lower, you simply do nothing. But in this example, boom, we get this, and we get we get our fair value gap. Let me draw the expansion candle just like this, just to make sure you guys can see it. Boom. Now, does this wick trade back up to this wick? Let's just see in our example. Obviously, I'm not gonna, make a dumb example. If it went like this, would there be a 5-minute fair value gap in the market? No. But if it was like this, would there be? Exactly, there would. And you have to just be able to know. You're not gonna just be able to get that handed to you. You'd have to know. So let me draw out on my 5-minute fair value gap right there. It's not gonna be the full expansion candle. It's where the wick is to the third wick. So if it's bearish, it would look simply just like that. And I'll draw this out for you to see it a lot more clean, right? And bam, now we have that wick to that wick, and there is your gap. So now if we're down here, right? If we're down here, you have to put this to the context of your system. So if buy side liquidity gets swept right there and here, and the market starts reversing and it opens up a fair value gap, this is how you trade it to the bearish. Well, if buy side's taken, I can go short if I get my model presented. Now, am I looking for displacement back into the range? Meaning we came all the way back up here, but the range is, down here and in here. Am I seeing displacement? Yes. And why am I seeing displacement? Because there's fair value gaps in play. So now, once I see a fair value gap opens, I can short to these lows, right? I can short to this low and this low confidently. Why? Because they have not been taken yet. Equal lows not taken. We displaced back into the range. We already took out buy side. Now what am I waiting to trade the fair value gap? And how do I trade it? I simply wait for the market to tap back inside of it right there. And as soon as it touches the bottom, that's your optimal trade entry. Meaning as soon as it touches the high of the last wick bearish, right? Meaning this is the high of the last wick of that bearish fair value gap. And you simply go short. Stop above the gap for tight risk, or stop above the second candle's close for, even, it's still great risk, but you're confident. And what am I doing? Targeting sell side. I would have my break even right here. So money right there. And I would look for a candle closed out of it, just like that. And then boom, I will start seeking sell side. And you let the market just work. Once this low gets taken, I would be break even, looking for the market to then do something like that. And right there, you would have a simple short trade. So these trades are all over the market. And let's find something to show you what displacement back into the range looks like, and as well as how I'm trading these, these gaps in real time. So I'm going to just shuffle back a tiny bit, right? And then boom. So we have a low right here. We have resting lows right there. Bam. And then boom. Mind you, this is a random example. This is Friday. I did not trade Friday. So I'm not going to just like straight up go crazy into depth, but boom. Let's look to the left of us. Do we have a high right here? Yep. Do we have a high right here? High gets failed, but this high gets taken. We have our buy side liquidity swept. We're on the 15-minute time frame, right? We know we have sell side down here. Sweep. And there we go. And we have our external liquidity. So what happens first? We buy back up. We're buying back up. Boom, we take this high here. So now what are we going to do? We're going to shuffle down the time frame. We want to see a displacement move back into the range, which would be bam, bam, bam. Why do we know that is displacement? 5-minute fair value gap opens up in favor. We draw it out, has yet to been tapped. So this is an unfilled, wide open 5-minute that is still being able to be used on Monday. Let's jump to the 3-minute. Let's look for a gap that has been used. Let's look for our displacement and our move. Right there. Inside of that 5-minute gap, what do we have? I'm going to erase it for you to see. This is that 5-minute gap. inside of this entire leg of this displacement move, right? What do we get? Right after buy side swept, it's right after, because I'm now allowed to go short in my model, right? Well, one, after this displacement move, we get, after this buy side taken, we get displacement, first wick through the second candle's body to the top, bam. You're now capable to go short in this position. As soon as it taps into this gap, bam, you're short. Stop can go at the wick. It can go at the candles close, preferably the second candle's wick, but even this, you're still protected with tight risk. You're not stopped yet. You could go at the top, but you're obviously stopped. But you would wait to see how that volume of that candle looks. And if you're gonna get a fill right there, you're better off going stop here. You would stop at the high. Everything is situational. And now what are you doing? You're targeting sell side, you have lows here, lows there, and you have a huge risk to reward, which is super clean. But now let's jump back to the where that 5 minute was at, because we've seen displacement on the 5 minute as well, right? Bam. Wide open fair value gap. Yet to been used. And then look right below it. Same one. A wide open 1 minute, yet to been used. And what happens? We tap inside of that. Bam. You can go short here. Stop above both of the fair value gaps. Preferably the second candle's close. Great risk. Targeting your sell side liquidity. Here's what the sell side looks like on the 1 minute. So bam. You target that. Target here. As soon as this gets taken, you can go break even. And now you can watch your trade play out. And there you go. So the first step to trading is obviously knowing where your liquidity levels are, your sell side and buy side, obviously. It's knowing where the draw on liquidity is as well, which I'm going to make a video on that soon. But it's simple as that, right? And that's how you trade the fair value gap. So it's something you're looking for that aligns with your context and it aligns with your favor. So, for example, if I seen sell side swept here, just like that, obviously I will zoom out to see, is there any more, sell side? Bam, right here. Low. Low gets taken. We have a low here, but does it get taken? No. So we already swept out sell side and we're not seeking to push lower, right? So now I'm going to look for that displacement move back into the range. A displacement move is when we open up a fair value gap. So what happens here? No displacement. We're getting back into the range. We end up wanting to take out this again. We fail to take out that low. Boom, displacement, 5 minute gap opens up. And here's an example where the market does exactly what you'd like to see and it does not play out because you probably or most likely will get stopped. We have buy side right there. And then we obviously have, some buy side resting up there. 5 minute gap opens up. We take out this internal low once more right there. And you can go long here as soon as we tap. Stop goes here. And eventually you get stopped out. But does the market continue in its favor? Yes, because all of this is just algorithmic. It's going to do exactly what it's supposed to do, regardless if you get stopped or where you put your stop loss. But that's an example to show you can follow your rules, you can do everything you need to do, but the market sometimes just does what it wants to do. So now let's zoom in here and see what happens. Because all it is just fractal, right? So say you get stopped here on that move, right? Now, are you bearish or are you bullish in this position? Well, we took out sell side. We took the internal low. In my opinion, I would still be bullish. So I want to see displacement back into the range. So boom, this candle's wick came all the way down here. We traded back up, closed, opened up a new 3 minute. Boom, boom. Do we open up a gap? First wick, third wick. We draw it out. Simply just like that. And what do we open up? A 3 minute fair value gap. You go long. As soon as we tap back in, you're long. Stop goes to the body of the second candle's close right down there. And what are you? Long to buy side. Great RR. You could even continue targeting more. Take off your partials here. And you're simply just taking your trade like that. So those are just some examples of how to trade the fair value gap, how to use it to your context, meaning sell side or buy side gets swept first. You look for a displacement move back into the range, and you trade it simply as that. So again, it's going to be a quick, short little video because it's not something that is meant to be taught for hours. It's simply as you need to put the hours in using your model, right? I'll simply put it like this. I'll go like that. We go like this real quick. Line, bam. I'm gonna put this right here. Text. So first, search for liquidity. We're gonna put buy side liquidity / sell side liquidity, right? Second, wait for displacement back into the range to either side. So it means to either side. So buy side liquidity was swept first. Wait for a displacement move back down. Wait for the gap to open up. Wait for us to trade back up into it. And then you could take your short because buy side liquidity was already taken. As simple as that, to either side. Third, wait for a 1 minute. If you have the 2 minute, you can use it. It's going to open up on all of these time frames, or 5 minute. Fair value gap to open. Those are your rules when you're seeking something and you're trying to find a trade, because I guarantee you it happens on every single time frame. So we'll leave this here, right? Buy side liquidity taken. Does this get taken as with it? Bam. Buy side liquidity takes. I just now scale in because this is the 4 hour. I scale into the 15 minute. Let's see what happens, right? Buy side liquidity gets taken. What do? First wick through the body, through this to the top of the third wick, and you draw it out. Buy side liquidity gets taken. Displacement move comes back into the range. What happens that next morning? 8:45. If you were short in here and you had your stop above that second candle, that wick up here, and you targeted a new sell side resting, and you were targeting down there, you banged. If you're targeting here, you banged. Doesn't matter. And what are the rules? Search for buy side liquidity, sell side liquidity. Well, our buy side liquidity was taken. Wait for a displacement move back into the range, right? We displaced back into the range. And then what happened? We wait for that fair value gap to open, which it opened. It gets tapped once, twice, takes out the high inside of it. So that's another internal buy side taken. And what do? When we open? Call to sell side. So you're always, and obviously wait for that. Let me just put this here as well for the last one. To open and get filled. And now, fourthly, target opposing liquidity. So it happened, this is like a step by step, and you're trading it opposite. So if buy side's taken, you're going to target sell side. If sell side's taken, you're going to target buy side. Target opposing liquidity And you should be doing all this on paper. If you're just learning, and if you're just trying to see the model, I will be teaching, my internal model and like how I trade it. I literally started doing this, and till this day I still use this, but now on sometimes a smaller time frame, because all prices is the same way each time frame. Just because it looks a little bit different, more candles pop up. It's the 15-minute trading up. This is the 30-minute trading up. Even 30-minute, we trade into this 30-minute. 15-minute will show you that it's still held. 1 hour won't show you every single thing you need to see, but when you get more advanced, you will see. And what do? We continue just to sell off. So again, that's just a little example of how to trade fair value gaps. What are they and what do they consist of? I hope you guys enjoyed the video. Thank you for watching. There's going to be more content in the future showing you guys how to find the draw on liquidity, what are SMTs, what are this, how to add confidence to your trade. But other than that, I just put the sauce into the video right now. Use it, practice it day by day, week on week, just don't give up on it. So at the end of the day, this is what I do. I did that same step by step till this day, and it has turned me into, I would consider myself a profitable trader, passing accounts, getting payouts, and, just overall just enjoying the trading journey because, I stuck through. So that's going to wrap it up. I appreciate you guys for watching. Until next time, peace.